Hey, welcome back into the podcast. So today, if you are a real estate investor thinking about selling a property and gaining some much needed income on a larger property, we're going to talk about 1031 exchanges with one of the best around, Kandas Myer with 1031 Specialist. How are you?
I'm doing great, Ken.
Thanks for coming in. I appreciate you coming in. We just did one, but it was the basics.
Yeah.
And Kandas said, well, why don't we do 2.0, the more advanced techniques? So today what we're going to do is we're going to review the basics so everyone has a basic understanding of how a 1031 works. And then we're going to talk about the 2.0, the more complicated, more outside the box ideas on how you can sell a property and get into a different type of investment. So
that's it.
You ready?
We're plowing forward.
Okay, so once again, we're going to talk about basics. So basic 1031 exchange questions.
Okay.
I'm going to put her on the hot seat.
I'm ready.
So, can you explain what a 1031 exchange is and how it works for real estate investors?
Absolutely. Okay, 1031 refers to the federal tax code, section 1031. And what it says is that if you have an investment property, in particular real property, and it's an investment property or an income property, or you house your trade in that property, you can sell that property without paying capital gains tax if you use that section of the tax code to defer taxes into another property of equal or greater value that is also used for one of those three uses: investment or income producing, or you house your trade in it. So that is what a 1031 is, and it's massively powerful because it keeps your equity from getting the tax bite. And it's one of those tax codes that not many people know about. Mm-hmm. And so it's really nice to kind of say, hey, you know what? This is something you can do to help protect your equity, help protect the generational wealth that you've built into the real estate that you have, so that the tax bite doesn't come out of it when you decide you need to sell one and buy another.
Great. So that's a really good start to what we're doing here. So, but the next question is, I think you just answered this. What are the main benefits of 1031 exchange to a traditional sale? And obviously,
the probably the number one benefit.
Number one benefit
is keeping the equity intact. But there's other benefits. For an example, you have an investment property that isn't performing well. Or you have an investment property that situations are changing.
Oh, wow.
You know, the HOA's shot up in value. The neighborhood has changed. It's become a maintenance hog. For some reason, the property doesn't suit you any longer. Maybe you've moved away and you need that property to be closer to you. Maybe you're going to move to a situation in another state and you want that property to be closer to you in those circumstances. So whether the property's performing well, whether you want to change the nature of the investment, you want to change the location of the investment, maybe you don't want to own residential anymore. Maybe you want to own commercial. Maybe you want to own industrial. Maybe you're sick of being a landlord and you want to buy raw land and not worry about it anymore. Okay, those benefits of 1031 exchange are the same. Yes, you get to keep all your equity, but you also get to do any number of things on the other side to make that property make sense for you and your investment portfolio.
So she's the queen of this. So she's the great explanation. So there's lots of benefits, and if you're in a rental property you don't care for, that's what this podcast is all about, is how do I investigate or look into other options that better suit your lifestyle or whatever situation you're in, correct?
Yeah, it's all about making it fit what you need.
Okay, so a few more questions on the basics, and then we're going to get into the 2.0, the more advanced.
Okay.
So a lot of questions come up about the types of properties that qualify, and what does like-kind mean in the context of the 1031?
Great, and we kind of wrapped it into the first two responses, but
right.
I'll be more clear. Like-kind refers to how the property's used. And I gave those three parameters. It's investment, in other words, usually raw land is investment, or income producing, or you're housing your trade in the property. It can also be a combination of those things. For an example, ranch and farmland is a great example of a combination property. Part of it's a primary residence, Part of it might surround the primary residence as part of the yard. And then there's a vast amount of acreage that is either held for investment, or maybe they're growing rye or wheat or, garlic or, whatever, peach orchards, whatever it is on the property, you can have combination use property as well. So those three things are what like kind revolves around. And what we're going to talk about later, although I'll kind of give us a teaser there, is there are also non-real property options that are considered like kind. And so we're going to talk about those as we get into the more advanced ones. But you've got things like oil and gas royalties, certain kinds of other investments that I'll talk about later.
So if someone has a question about that, who do they talk to? Do they talk to their accountant? Do they call you?
I would talk to me first.
Okay.
Usually the accountant is also talking to me, and so I'll just say, and this is without trying to sound like some special or whatever, but this is a very obscure area of tax code. And usually the accountants and attorneys that I encounter are not as familiar with 1031 as they might be with other areas of accounting and tax law. And so, I find usually we're putting our heads together with the attorney and the accountant to kind of come up with the correct answers. With our knowledge of 1031 and then with the attorney or the accountant's knowledge of the client's portfolio, then we can work something out. So I would give a call to me first and then talk with the accountant.
We talk about this a lot on this channel, is make sure you're creating a team around you. Accountants, attorneys, 1031 specialists.
Yeah.
A real estate, everyone that can help you form your opinion and get the best solution for your situation, right?
Right.
All right, so basics. We're still talking about the 1031 exchange questions, basics. Got 3 more.
Okay.
I want to quickly talk about the deadlines that people need to be aware of. So when the 45-day identification period and the 180-day closing period, to be specific.
Real short one. On the day you give up title to what you're selling, the next day is day 1. There's 180 days ticking. The first 45 of those days is an identification period. The rest of that time is they give you that to close escrow on it or acquire what it is you're acquiring. If you need 180, you don't have to take them, but you have a 45-day window to identify, a 180-day window ticking from the same time, ticking starting with the same day that you have to close escrow on what you're buying.
It's that simple.
Real simple, yeah.
All right, so now we're talking about her position, and what she's called, correct me if I'm wrong, is the role of the qualified intermediary in the 1031. So why is that required?
Okay.
And that is your role, correct? That's
the role of our company.
Okay.
Our company functions as the qualified intermediary, and within our company we have people like me that I call myself the gatekeeper, or the does it fit, does it look, walk, and quack? I'm going to counsel with the client and determine whether it fits the 1031 safe harbor guidelines. And we're going to pack this together once we know it fits, once we've got an open escrow on a relinquished property. Now I'm going to assign it to a document, what we call our exchange officers. And the exchange officer, just like an escrow officer, is going to work the exchange side of the paperwork, which supports the position of the qualified intermediary, which is our company, to move the money in an exchange and to do the documents necessary for the exchanger to look, walk, and quack again, like a 1031.
Okay. So, 2 more questions for the basics to make these quick. Are there any significant restrictions or common pitfalls that can disqualify a 1031 exchange?
Yeah. Okay, so
have you had any?
Well, the most common.
What are the common ones?
The most common misunderstanding in a 1031 is that the exchanger only has to reinvest the cash that they've earned in order to have no tax. So, as an example, we'll just use an easy one. I'm selling at $500,000. I owe $300,000. I have to buy at $200,000 when I buy a replacement property, right? This is wrong. If I sell at $500,000, I have to buy it 500,000, no matter what I owe on the property. That's the most common misconception.
Okay.
Is the balancing the loan side. The 1031 has to, in other words, if you want your taxable event not to happen, if you want to defer all the tax into the property that you're buying, you have to buy equal or greater value. The equity has to be equal or greater in what you buy. So in other words, I can't pull some cash out and use it elsewhere and replace that with a loan. Okay. And then the debt, if you have debt, needs to be equal or greater on the buy side. Or replace it with cash, because obviously if you buy equal or greater and you have some debt, you got to figure out how you're going to replace the debt. You're either going to get another loan on the buy side, or you're going to add cash to it. So that's the most common misconception, is the equal or greater value.
So it's sale price?
Sales price.
Or is it sale price minus all the closing costs?
Only non-recurring closing costs get to be taken
so
off.
refresh people's memory on what.
Non-recurring.
Yes.
The easiest way, if it's prorated, it's recurring. Okay, so what is not prorated? The real estate commission, your transfer tax. Those are the two big ones.
Okay.
Okay. There's a little bit of piddly stuff after
Transfer
that.
tax?
Transfer tax is not prorated.
Okay.
We're not talking property tax. We're talking state transfer tax.
Okay.
Okay, so that is not prorated. So those are the two big ones that are non-recurring. Generally speaking, those non-recurring fees don't amount to much more than 1%.
Okay.
Okay.
Yeah. So if you're buying a 500,000, 495, but you'll get a net sheet that you'll see, and you'll say, when they come to you, you have to buy a house that's X amount, correct?
Usually I counsel them from the get-go and let them know approximately how much they need to buy not to have any taxes. And now they know that they've got a target that they need to hit. If they're going to come under that, they're going to have some taxable.
Is it prorated? So if you buy, like, when I say, like, if you don't use the full amount, let's just say you don't buy a $500,000 house, you buy a $450,000.
Right.
Is that $50,000 that's taxable then, or how's?
Whatever minus the non-recurring closing costs. So I sold at $500,000, I bought it $450,000. Whatever the non-recurring closing costs were, the difference between that figure and what I actually bought will be taxable. And then that is actually broken up into depreciation, recapture. Yeah. And then of course, there's a bunch of other gatekeepers there with, trying to figure, that is a big rabbit hole. So that's when I say you need to talk to your accountant. You talk to your accountant, because he or she is going to have a better picture of what that partial tax is going to be.
Okay. We're going to skip the next question, because it's talking about what types of properties or assets are specifically excluded. I guess we can. This is excluded. I thought it was included.
No, let's
talk about. So these are the ones that you cannot. So if you're out there thinking, oh, I'm going to go buy a house like Tahoe and make it my second house.
Right. So, your primary residence is excluded. It has to be.
Unless it's like a farmland or something.
Well, if it's a combination property, there's a different application. But most of the time, the primary residence is, one where 100% of the property is used for personal use. Second homes, unless they have a rental history, they're not going to qualify for 1031. And that rental history is extremely specific. I won't go into it here. But there's vacation. A lot of people think they can just 1031 a vacation home because it's not their primary. That is incorrect. So vacation homes, stocks and bonds, normally those are not 1031 exchangeable. Let's see.
What else is there?
Well, personal property that's used in business, like business equipment.
Okay.
Yeah.
So
that's
my recommendation is talk to your accountant, Kandas. You're thinking about selling. Don't get in sell it and then think you can go get an airplane or all this other stuff.
That goes back to the other question: is don't sell it before you talk to us and we get involved in the escrow process with you, because that's the third most common mistake
is they sell
it and then they come to us and say, well, we're doing an exchange and we need an intermediary. You needed the intermediary before you closed escrow.
Yes. So the money can never go in your pocket, and that's what you're saying.
Well, and not only that, there's documents that have to be done.
And you do all that as part of your.
We do all that as part of the qualified intermediary.
Okay, and then not to talk about fees, but there's a fee that you charge people.
Yep.
And what you do is you pay that fee, and then she comes in and her company takes care of all the paperwork, make sure that you're following all the guidelines, right?
Actually, it works in reverse.
Okay.
Yeah, we come in, you come in, we counsel you. You go into escrow. We present documents to you to sign. We do some instructions to escrow. When you close escrow, then we charge you.
Okay.
And so, yeah, our fee doesn't happen until you actually close escrow, and it's a non-recurring fee, so you get right off of the.
That sweetens the deal.
Yeah, and it's less expensive than your commissions. The fee is just $11.95, and it's a flat fee
not too bad
for everybody. So that makes it real easy.
And then, but you need to let a lot. I think you just pointed this out, but I wanted to reiterate because we see it a lot. Is they think, oh, we had a title company involved. You know, when you sell a property, oh, there was a title company that took our money. That's not a third-party intermediary. Not all title companies are third-party intermediaries.
No, there has to be an actual intermediary.
With a license
who's involved, that doesn't have anything to do with the title company, doesn't have it. And I should maybe soften that a little bit, because some title companies have an intermediary arm.
Yep.
Okay, that is separate from their title company. And that's okay. There's a whole group of independent QIs, which is where I am, okay, which we're independent of any title company, so we're not beholden to any of their stuff that they might want to say you have to do because we're part of their family. You know, that is kind of a plus in my book.
Okay.
But, you know, either way, you can't not have the intermediary involved if you're going to do a 1031.
So, call me. Call Kandas, get them involved early, because you have ideas too, right? On what can and can't. And she knows people you can probably talk to and say, consider this. So there's a lot of options. It's important to get these people involved early.
Yeah.
Last question for basics, and then we're going to get to the meat and potatoes here.
Okay.
How are taxes ultimately handled? How are they eliminated or just deferred? How are they eliminated or are they just deferred? And I want to talk two things. Because there's a few taxes that are being deferred that are kind of depreciation and capital gains, correct? Those are the two I want to kind of talk about.
Right. So basically what's being deferred are whatever you would be paying in what we call a taxable event. And that taxable event would be comprised of a your gain by depreciation, and then you have your gain by appreciation. But to make that simple in my mind, I call it depreciation recapture. Okay, you're going to grab some money from me because I didn't pay money on some of my income through my depreciation.
Okay.
And now I have to pay that to Uncle Sam if I don't do a 1031. Right. The other part is it's usually long-term gain that is being deferred. And then that taxable event and the gain that created it, that sits in the new property. You don't have to pay it. It just sits there in the new property. And if you gain more appreciation in the new property, then that kind of ups the ante a little bit. You can do another 1031 and defer the taxes again. So you don't really ever have to pay the taxes unless you actually sell and don't replace it with an investment or income property, which again, it makes it extremely powerful.
Yeah, it's like almost like a retirement account where you never pay, you just keep.
It is. And speaking of retirement account, you know, I've let people know that when they say, well, I need some money to do this or that, well, you can always refinance if it pencils out for you to refinance. If you still make money on your rent and so on, you can refinance money from the buy side because that's not a taxable event.
Beautiful.
You can handle the money on the other side, not on this side or in between. But once you settle over here, that can be refinanced. You can pull money out if that is what you're trying to accomplish.
Talk to your accountant, but that's why she's here. Last thing is I want to talk one quick thing about. So when you buy a property for rental, you have what's called depreciation, right? You get depreciated. It's divided by 27 and a half if it's residential property,
Mhm.
and that's figured out when you buy it. But when you sell, let's say at year 10, you have a rental, you sell, you move to the next one. Do you get a reset? Because you're still 17 years left, right? 17 and a half years left for depreciation. Do you get to reconfigure that depreciation? Or
This is why you have a really good accountant, okay? This is
Talk to
why
your
you
accountant.
need an accountant on this one really bad, and hopefully they're the same accountant from when you bought that property. Because what happens is you're gonna have a depreciation schedule that's going along at that amount,
right?
right? And then you're gonna have a new depreciation schedule for the new amount with the 27 and a half year window. So no, you don't get to add the time to the old depreciation schedule.
Okay.
That's the answer to your question.
Okay.
So the more you do this, okay, if you do it, I've had some customers, they, exchange into something 3 times. So the way back when they exchanged something from California, and then they came to another state, then they came into Nevada, and so now they're on their 3rd exchange, and their answer is, well, what's my depreciation? I go, do you have the same accountant? And have you kept track? Because the 8824 form is what you file when you do an exchange, and it helps you to track that stuff.
Okay.
And so that's where it's really important, because I can't do the accounting for you. I can only tell you conceptually, no, you don't get another 27 and a half years. You still have the same amount of time left.
But you just get a new whatever the
you get a new depreciation
for the next
schedule
17
for
so
a new which is
for
the
10 years.
Right. The
So it's then
difference
17 and a half.
between, right.
What happens if you change to a commercial? Then you're at 39 and a half.
Oh, that's a good question. Well, what happens, you still have your 27 and a half year, or whatever it was here, and
Right.
whatever you used up of that.
Yes.
Now, the new schedule is for the amount over and above that,
okay,
that you purchased. And if you switched to commercial, now you've got a 39-year schedule on that difference. I knew the answer, yay. Just had to walk through it.
All right, so that's the basics. That was just the basics. But it's a good review because once you start talking.
Exercise my brain. That is the basics.
But now we're going to talk. So if you have any questions about that, comment below. We'll get. What's your number, real quick?
775-710-9119.
So we'll put all of her contact information, her website, email, the whole shebang in the wherever we're posting this. So call her. Okay. We encourage you. We work with her, and it's important to have someone like her involved early, especially when you're doing a basic one, your first one. Some people do more advanced ones. So now.